Now we're going to discuss definitions and terminology related to commercial mortgage loans. Please note that these definitions and terminologies are not all-inclusive, but they are the basic information that you'll typically run across. So buckle up because there's a bunch. After repair value. ARV is the estimated value of a property after all renovations and repairs are completed. It helps investors determine the potential profit from a property flip. Blanket loan, a type of loan that covers multiple properties under a single mortgage. BRRRR, pronounced BRR, stands for buy, renovate, rent, refinance, repeat. It is a strategy where an investor purchases a property, renovates it, rents it out, refinances the loan, and then uses the proceeds to repeat the process with another property. It is highly popular for wealth building and growing a rental portfolio. This is your golden goose investment type. When you fund the loan for the borrower to purchase and renovate a property, you'll receive your commission for this. When this same borrower has finished renovations and needs long-term DSCR financing, more on that later, to keep the property as a rental, you'll earn another commission when you fund a DSCR loan for them. It gets better. This is a popular investing strategy, and most investors don't stop with just one property. They typically use this process to grow their portfolio, which provides them with increased monthly cash flow and net worth. Even a single investor who does this with multiple single-family homes can provide you with significant income. Capitalization rate. The cap rate is a metric used to estimate the potential return on an investment property. It is calculated by dividing the property's net operating income by its current market value. Capital expense refers to the funds used by a company to acquire, upgrade, and maintain physical assets such as property, buildings, or equipment. These expenses are typically long-term investments that improve the property's value and extend its useful life. Cash flow refers to the net amount of cash generated by a property after all operating expenses and debt service are paid. It is a key metric used by investors to assess the profitability of a property. Cash-on-cash return. COC is a metric used to measure the annual return on investment, calculated by dividing the annual pre-tax cash flow by the total cash invested. It helps investors evaluate the profitability of a property. Collateral, an asset pledged by a borrower to secure a loan, which the lender can seize if the borrower defaults. It provides security for the lender. Debt service refers to the total amount of money required to cover the repayment of interest and principal on a loan over a specific period. It's the commercial lending version of the word mortgage. Debt service coverage ratio. The DSCR is a measure used by lenders to assess a borrower's ability to repay a loan. It is calculated by dividing the property's net operating income by its total debt service. A ratio of 1 means the property would break even and anything less would have negative cash flow. A lender's typical minimum required DSCR is at least 1.2x. Fix and flip, an investment strategy where an investor buys a property, renovates it to increase its value, and then sells it for a profit. Gross rent refers to the total rental income received from a property before any expenses, such as maintenance, taxes, or utilities, are deducted. Interest points. In commercial lending, it refers to upfront fees paid to the lender at closing. Each point is equal to 1% of the loan amount. Joint venture. A JV is a partnership between two or more parties to develop or invest in a property. Each party contributes resources and shares the profits and losses according to their agreement. Loan to cost. LTC is a ratio that compares the loan amount to the total cost of the project, including purchase price and renovation costs. It is used by lenders to assess the risk and feasibility of financing a project. Net operating income. NOI is the total income generated from a property after deducting all operating expenses, but before accounting for taxes and financing costs such as debt service. It is a key metric used to assess the profitability of a property. Non-recourse loan. A type of loan where the lender's only claim in case of default is the collateral, and they cannot pursue the borrower's other assets. Operating expenses refer to the costs associated with maintaining and managing a property, including utilities, property taxes, insurance, maintenance, and repairs. Recourse loan. Opposite of non-recourse loans, this type of loan is where the lender can claim the borrower's other assets beyond the collateral if the borrower defaults on the loan. This provides additional security for the lender and is very common on smaller loans. Rate. This refers to the interest rate on a mortgage loan. Return on investment. ROI measures the profitability of an investment as a percentage by comparing the gain or loss to the initial investment cost. ROI is calculated by dividing the net income from an investment by the initial investment and then multiplying by 100. Hey, guess what? You did it! That's the last of the definitions. In the next lesson, we're going to talk about what commercial loans are all about.